Who gets to profit from stablecoin yield? Banks versus crypto firms, traditional finance versus the new guard. But that fight is obscuring something more structural. A single tweet from the White House this week pulled back the curtain on what the Clarity Act debate is really about. And it's not what most people think. For months, the conversation has centered on one thing: who gets to profit from stablecoin yield? Banks versus crypto firms, traditional finance versus the new guard. But that fight is obscuring something more structural. On Monday, Patrick Witt, executive director of the President's Council of Advisors on Digital Assets, convened a roundtable with senior figures from both crypto and traditional banking. The goal was to find common ground on the Clarity Act, a bill marketed as a market structure framework designed to deliver regulatory certainty, though it has faced substantial pushback from parts of the industry. The crypto world reacted with familiar outrage. Why were banks being invited to negotiate the rules for products that directly threaten their business model? Yield-bearing stablecoins compete with bank deposits. That criticism is reasonable, but it also allowed a deeper issue to go almost completely unnoticed: privacy. The Clarity Act defines regulated crypto roles: centralized exchanges, stablecoin issuers, custodians. Once those roles are formally recognized in law, they become part of the existing financial system. And that system operates under the Bank Secrecy Act. The BSA requires financial institutions to know their customers and report suspicious activity. It's the foundation of anti-money laundering compliance in the United States. But the Clarity Act doesn't specify how BSA requirements should apply to on-chain activity. It doesn't define what compliance looks like when the underlying infrastructure is decentralized, pseudonymous, and global. That silence matters. When a law creates obligations but doesn't define how to meet them, the vacuum gets filled by the most risk-averse actors in the system. In this case, centralized exchanges and stablecoin issuers. Faced with legal uncertainty, these firms don't interpret the BSA narrowly. They interpret it maximally. They equate compliance with total visibility. They build systems that assume every transaction needs to be traceable back to a verified identity. That assumption is not what the law requires. The BSA mandates identity verification and suspicious activity reporting. It does not mandate blanket surveillance or require that every on-chain transaction be transparent to intermediaries. But when the rules are vague, institutions protect themselves by going further than necessary. We already see this pattern today. Coinbase has never listed Monero, with CEO Brian Armstrong citing in a 2020 interview discomfort by U.S. regulators as the reason. Binance has placed privacy coins like Zcash and Monero under monitoring tags, threatening delisting unless projects implement transparency measures. Zcash avoided removal only by creating special exchange-only addresses that allow transaction tracking. These decisions reflect a risk calculus shaped by regulatory ambiguity. Once the Clarity Act passes, that calculus becomes permanent. By embedding crypto intermediaries into the BSA framework without defining how privacy should be balanced against transparency, the bill locks in the most surveillance-heavy interpretation as the baseline. Privacy-focused projects face the greatest pressure. Monero, Zcash, and any protocol that prioritizes confidentiality will be treated as too risky to touch, not because they're illegal, but because supporting them creates compliance uncertainty. And it's not just privacy coins. Any innovation that builds privacy by design will face the same calculus. Developers will be forced to choose between building tools that preserve financial confidentiality and building tools that can be listed on regulated platforms. This is a policy choice being made indirectly by inaction rather than through open legislative debate. Congress has not openly debated the trade-offs. It has not weighed whether privacy by design is compatible with regulatory compliance or whether the two must be mutually exclusive. It has not considered what happens when intermediaries, not legislators, decide which technologies are too risky to support. Instead, those questions are being answered by default, by exchanges protecting their licenses, by banks protecting their market share, by regulators avoiding political risk. The Clarity Act could have explicitly carved out space for privacy-preserving tools that meet BSA obligations without requiring total transparency. It could have acknowledged that financial privacy is not inherently criminal and that pseudonymity is not the same as anonymity. But it didn't. The stablecoin yield debate will continue to dominate headlines, but the architecture being built beneath that fight will determine what kind of financial system we're allowed to build, whether privacy is treated as a feature or a bug, whether innovation that prioritizes confidentiality can survive in a regulated environment. Right now, those answers are being written in silence, and that's what the White House tweet exposed this week.